I saw this YouTube video that was on $10 a dozen eggs. I had just bought $10 a dozen eggs, and it was from the same company, so it was interesting to me. I'm going to cover that. I'm also going to cover the direction of the market and where I think it's going and where others are seeing that it's going, how long, and what happens after that. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is December 26, 2023. So when I saw this video, it was on Vital Farms, the company Vital Farms. And they're a $460 million a year in sales business, selling eggs for $10 a dozen. What's interesting is they're the second largest producer of eggs in the country, and there are other eggs available, $4, $5, $6 a dozen, and these are 10, and people are buying them. Well, I drilled into it a little bit more and I learned what was going on. They are truly free-range chickens. A lot of eggs say they are free-range, but here's what happens. They put them in the bin, in the chicken bin. They have a door. They go in and out. When they go outside their bin, their range is 1 square foot. That's not a range. But the wording, they can maneuver through the wording so that they can qualify for free range. And then they go organic and grass-fed and all the buzzwords that you want. But the range in price goes from $4 or $5 on the low end, let's just say $5, to $10 on the high end. But they all sound good. You look at all of them, none of them just go regular. They all have got these things that want you to cause you to buy them. And anyway, so I buy these. Well, the other thing that's part of this that's interesting to me is I raise ducks. So we have free-range ducks. People don't talk about that. But we've got about 1/3 of an acre that's fenced, and I have 10 ducks inside that. Now, that's our garden, and it's, it's a lot of property for 10 ducks. So they go through there and they forage, and in the summer they find all their little critters that they eat and everything. But they produce really, really good eggs. And I'm going to show you a picture of one. And so what I do is in the morning, I fix my breakfast. I fix one of the Vital Farms true free range eggs, and I put a duck egg with it. Duck eggs are kind of rich. I mean, not everybody likes duck only. So, but when you put duck with chicken, it works out just fine. Or you could do chicken only. But these ducks are producing a lot of eggs, so I'm trying to eat them. And so I put the chicken and the duck together, makes a real nice breakfast. And then they produce nice eggs. So anyway, I'm going to play this clip. It's a real interesting piece on Vital Farms. Now, this is not a paid commercial. I'm not really a spokesperson for Vital Farms. It sounds like I am actually, but they're really a good company, and they kind of stand alone. They're out there by themselves. Everybody else is doing this kind of wannabe free range, but they're not really, and they're competing on price. And here's Vital Farms way out here at this expensive price, and they're selling like crazy. And anyway, it's just an interesting story about value, I guess. So take a listen to this, and then I'm going to show you a picture of my breakfast eggs before I cook them. Take a listen.
What's the most you'd pay for a carton of eggs? $3? $4? What about $10? The near $14 billion shell egg market in the US has all kinds of terms. Organic, cage-free, free-range, pasture-raised. But there's a company that feels one is the most vital.
When I first got into the business, I heard the terminology all the time. An egg is an egg is an egg. I talked to a chef in a restaurant, and I'd give him a case of our eggs, and then I'd get a call back that they'd say, holy, this is not what I expected it would be.
This is Matt O'Hare, founder of Vital Farms, a network of family farms committed to producing the highest quality and most ethically created eggs ever made. Today, it is the largest pasture-raised egg brand in the U.S., sold in close to 24,000 stores.
Our growth rate from inception has always been tremendous. The model that I envisioned at the very beginning was very similar to the model we have today, which is to teach farmers how to humanely raise laying hens in an environment that is really good for the hens and good for the farmer, to pay them extra for that, and to produce an egg that was never been done before on a national scalable level.
There are three numbers to look out for in this story. $250,000, the cost of the farm Matt started his company with. 300, the number of family farms today that have been onboarded into the network. And $465 million, the company's projected net revenue for 2023.
I think people want to know where their food comes from because it's the most intimate thing we do with our bodies. It's not sex, it's food.
Here's how what started as merely 20 Rhode Island hens on a 27-acre farm grew to the second largest egg brand in the United States at retail.
Okay, this morning I took a picture. So before I mixed my eggs up, I put them in a bowl, and I just thought I would show you the difference. Okay, so if you know duck eggs, you know which one's the duck egg. It's on the left. And the one on the right is just, it's a Vital Farms true free-range egg. But the mixture works out pretty well. Anyway, I just thought I would show you that. There is a big difference. And hats off to you if you can eat duck eggs only. That's not necessarily for me, but the mixture is okay. Okay, now I'm going to talk about, let you listen to this. This is really interesting to me. Of course, my videos are on YouTube, and YouTube is the number 2 search engine in the world, second to Google, and they're owned by Google. But when valued as a company by itself, which they do, they value the component parts of these companies. And when valued, if it were a standalone company, the number came out to $400 billion. YouTube, that you do your little searches and how do I fix my mower and listen to Ben or whatever you do, and $400 billion. Amazing. So anyway, take a listen to this.
Let's take it to Needham, senior research analyst Laura Martin, and get her take on the best picks of the group for the upcoming year. Laura, I know it's Friday before Christmas, so thank you so much for coming on. If you had to pick 2 of those names, who would they be?
So we would go with Google, which is also called Alphabet, and we would go with Amazon. Google, because we think political is going to be a huge ad year, which benefits Google, as well as we expect a rebound in auto advertising, film and television advertising, because there won't be strikes in 2024 anymore, and in travel advertising. All of those should feed into Google's sort of 70% profit margin business, which should over-deliver earnings per share. Similarly, Amazon, very interesting story next year. We think that what it's doing is pivoting from being a consumer-facing company, and now has 4th lawsuit from the FTC, to being a sort of business-to-business back-end infrastructure company with logistics and shipping, where it sort of takes a fee of every other thousands of companies, fulfillment plus cloud. And we're really optimistic about generative AI. We think generative AI will be the headline that everyone is the most sick of by the end of next year.
Oh, you just heard the Open AI. I know it's going to be, we say AI, Open AI, ChatGPT. Open AI is the parent company of ChatGPT. Google's got their own. There's all these competitors out there. Is there a way, when we talk about Google / Alpha, I still can't call it Alphabet, I'm sorry. We talk about Google, Laura, is there a way to value how much YouTube is worth? If YouTube and YouTube Kids were just spun out, how big would they be?
Right. So we value YouTube every single quarter, and we itemize everything that was said about YouTube for 8 quarters running. We just pull out what they say about YouTube. And so the answer is yes, we value it every quarter. It's between, if it was separately tradable, even if they just spun off 10% of it, we think YouTube alone would be worth $350 to $400 billion by itself standalone.
Next, David Faber is interviewing Dan Ives from Wedbush Securities and getting his take. And we're going to play you a few different views on this, getting his take on 2024, what he thinks is going to happen. Now, he is a guy who is always bullish on stocks, so he is going to give the optimistic view for what he thinks is going to happen in 2024, and it's kind of up, and just keep investing, and that Apple will lead the way with the Magnificent Seven, etc. So I'm not saying he's wrong. I'm just saying this is the optimistic view, and a number of people hold that. Now, right now, okay, so the end of December, here we are toward the end of December, and we have had, and I'm glad we participated in this, we've had a really good run for the months of November and December. It has been a very good period of time following a mixed first part of the year. We were up during the first part of the year, then we got out of the market during the decline in the third quarter, and then we got back in the early fourth quarter and have just benefited from this tremendous run. And anyone who is invested, has been invested or got invested during the months of November, December has probably done well. Most stocks have done well. So many pundits or analysts or money managers who are, at least, most of them are saying we're going to continue to accelerate into the first quarter. Now, not everybody agrees with that, but I've read more that agree that it's going to continue the acceleration at least into the first quarter. So I don't want to be a naysayer and say that's not going to happen. I think the second half of the year has got some challenges, but I think for now, it seems like we have momentum, and hopefully this will continue at least into the first quarter. But anyway, here's Dan Ives and what he says about what he believes will happen in 2024.
Yeah, you know the guy. He's Dan Ives, Wedbush Securities Analyst, and he joins us right here at Post 9, as ever, looking quite dapper. I don't think any of our audience will be surprised to hear that you're bullish going into 2024, and that a lot of it, what undergirds your thesis is the growth of AI. Why and what gives you the confidence that you'll be right?
I think it's really the use cases. I mean, use cases, that's the yellow brick road. You follow the use cases, that's where the growth's exploding. And I think when I look at enterprise software, when I look at some of really the transformative names, what's happened with Microsoft, what's happened in Alphabet, of course, godfather of AI, NVIDIA, and then you look at some of the pure plays, Palantir, MongoDB. I think the difference now is that it's going to spread to the rest of tech in 2024. I believe this new tech bull market has already begun.
Right. I mean, you've talked about this in the past being a moment similar to 1995, essentially the advent of the internet. When you talk about a spread, though, and you see what the benefits going to so many companies, and that will be reflected more broadly in their stock prices as well, beyond sort of some of the names we're looking at and other beneficiaries so far this year?
Yeah, I think the difference is that when I look at street numbers for 2024 across tech, specifically when I look at software, even big tech, I think potentially underestimated by 5, 7, 10%. So when you look over the next few years, even some of the bears now, they're coming out of their caves out of hibernation mode, starting to maybe reevaluate some of these names in terms of what the growth could look like. And that's why I think Magnificent Seven, I believe it's up 30% over the next year. But I think in terms of overall tech, we sit here a year from now, I think tech's up another 25% because of this transformational AI revolution that's now here.
I'm curious.
Then I'm going to play another view. This is from Scott Wapner interviewing Dan Greenhouse from Solus Alternative Asset Management. And he says what's happened is this year, we know this, it has been a concentrated market, concentrated in technology and further concentrated into the Magnificent Seven inside of technology. But during the last couple of months, it has begun to broaden out. For example, small cap stocks have started to rally and do very well, actually outperforming by quite a bit the large cap and so forth. But other companies beyond the Magnificent Seven are starting to participate in the current rally, short-term rally. So this is Dan Greenhouse's view of this, and it's an interesting view because this is more the way I would do it, is he says, if you're invested, if you're like a buy and hold investor, he says, start to take profits on the Magnificent Seven at this point. That's his view, because they are so overvalued, so overshooting the market that they're not going to go to the moon. He doesn't say that, but that's what he's implying. And he's right. That when you have that degree of profits, and if you're invested in those, go ahead and stay with them, but start to take some off the table and, as they say, take profits. So I think that's a good view. His other view, which I also agree with, is don't expect a repeat of 2023. I don't think it's going to be a down market. I don't know. There is going to be, in my opinion, a down part of the market, but I don't think it will last for the whole year. And but don't expect that 2024 is going to be a repeat. So maybe a roller coaster. Maybe it's down and then up some and then down some or whatever. I don't know, some combination. But I think it's an election year, so that usually spells good for the market. But I do expect some volatility. So anyway, take a listen to Scott Wapner interviewing Dan Greenhouse.
As Treasuries react to some pretty robust economic data all the way around today, which takes us to our talk of the tape. How far stocks are set to go in the new year with several potential challenges still ahead. Let's ask Dan Greenhouse, Solus Alternative Asset Management's chief strategist and economist here at Post 9. Welcome back.
Thank you, sir.
So as we close the week, what are we going to do here with this market as we edge towards the end of the year and go into the new one? Have we done too much too fast? Are we still set up for something pretty good as we begin a new year?
I'm generally a skeptic of any point markets have gone too far too fast. I mean, obviously there's overbought conditions that need to be worked off, but to the extent that the market was, I'll use the word insular, but that's probably not the right word. It's been very narrow.
Until lately.
Yeah, so for the whole year, only 3 sectors have outperformed. But over the last month, over the last fourth quarter, 6 sectors have outperformed. So you've seen the rally broaden out. We all know this. All else equal, I take that as a positive sign and sets us up, I think, fairly well heading into the new year.
Do you think that broadening continues?
Oh, I do. And we've discussed this in the past. And I think if you have 2 avenues here, do I want to continue to invest in the large 7 tech names, let's say, or the broader market? This is not so easy, but I would go with the broader market.
Then I'll play this piece from Dominic interviewing Ron Insana. Now, Ron Insana, if you've watched CNBC for a long time, you know that he was one of their hosts, and he's a very good host. And then he got hired by a firm outside of the media, and so he's in the financial industry, but he's got good views. And so Dominic is interviewing him and asking his view on the market for this coming year. Again, kind of a bullish view that he's expecting good things to continue into 2024. It's really hard to make predictions. When they put people like this on the spot, they have good opinions. I have my opinion, but the reality is nobody knows, But it's another perspective. So I wanted to play this because this will give you the third perspective on what is probably going to happen in 2024. Take a listen.
Ron, let's start with the bigger picture right now. This market rally was one that maybe some people expect because there are quote unquote seasonal factors at the end of every year that make it kind of a positive time for the markets. But a lot of people didn't call the massive rally that we saw for the balance of 2023. What gives and can it hold?
Fed's done. Period.
And that's the reason why.
That's it. I mean, I can't identify any other reason. It's not like they're, raising guidance on earnings in such a dramatic fashion that, you're going to see the market rip on that basis, or that there's any other thing going, aside from the economy not falling into recession and the economy not falling out of bed. Really underlying this, Dom, I think, and I wrote about this on CNBC.com today, all the measures of inflation are moving towards the Fed's target far faster than anyone had anticipated. You take today's core PCE, over the last 6 months, it's annualizing at a 1.9% rate. What else do you need? So everybody knows the Fed's done. Everybody believes the Fed cuts next year. And so that's reason enough to rally.
All right, so the market rally predicated in large part by what's happening with the Fed. Mike, this is a scenario now where if you're an investor and you say to yourself, I saw huge gains over the course of 2023, I don't feel as comfortable putting money to work, though. But sometimes the momentum keeps on going. Do you feel as though this is one of those scenarios that Ron just laid out where the Fed is done and it's an all clear sign for the markets overall?
I think directionally, yes. I think in general, everything that Ron said, I tend to agree with. Inflation's coming down. That's good. Markets like that. The Fed is kind of being investor friendly, saying there's a pivot coming and investors favor that. So the question is, what happens next year? Is this going to be significant momentum? Are we going to see a repeat? Are Magnificent Seven stocks going to do the exact same thing again? That seems a little bit unlikely to see this massive outperformance from some of the tech titans out there. However, if we just try to put these pieces together, what's happening? Macros look pretty good. The Fed is cooperating. People have jobs. They're out there. They're still spending. If you look at stocks and look at, are they expensive or cheap? They're just a little bit expensive. It's not terrible. So that's a pretty good setup. I think we put all those things together. If you're a long-term investor, I think you stick with markets. There's, a good odds of a good result next year. Maybe not quite the massive bull market we've seen in 23, but I think there's enough positive things out there to keep folks in the game for next year.
Okay, and finally, I'm going to play a piece. This is the most contrarian view, but it's not completely. It's not. They're not saying the market's going to fall apart or this is going to be a down market or a down year. It's not the case. Just a different perspective. So this is a view that is like not so fast. We're not going to rock into 2024. Matter of fact, the first quarter, coming off of an excellent couple of months, November, December, the fourth quarter is likely to be down. Okay, that's good. And especially the Magnificent Seven. We don't know that that's the case. This is an opinion, okay? But it gives you the alternative view. But probably, they're expecting a positive year, but maybe not a positive first quarter. And, take some profits. Don't expect the Magnificent Seven to be so wonderful. And 2024 is not going to be a repeat of 2023. Okay, I can accept all of that, but I would still say it, in my view, probably is going to be a positive year. When all is said and done, at the end of 24, it will probably be positive for all the reasons that you know and I know, which are interest rates are falling, inflation is falling, employment looks solid, and all the indicators are expanding in a positive way. So anyway, take a listen to this. This will be a little bit of an alternative view for you.
I want to talk markets right now. Our next guest says investors should have cash ready because he's expecting volatility in the first quarter of next year. Leo Kelly is the CEO of Verdance Capital Advisors. Good morning to you.
Good morning.
When people say cash, that means down. So you think we're moving down? Volatility that's a downward move. You're suspecting is in the offing here.
Well, I think cash today means something a little different, Andrew, because you're getting a rate of return on cash. I think if you go back a few years, you're right. There was no return. So the only reason to hold cash was that you think the market's going down, you want to buy back in. We're actually neutral weighted on equity, meaning we are where we should be. We are holding cash in lieu of long bonds. And as I said, the nice part about cash is you're right. We do expect volatility in the first quarter. And if the markets come back down off of what I think is a bit of a speculative run here, you want to have cash on the sidelines to be able to take advantage of that. I do think we'll see that volatility in the first quarter.
And you're taking advantage of it how? Meaning, what are the things you'd be looking for? Are you in the? I don't know if you heard Bobby Kotick. He actually slipped it in very delicately. He said he thought the recession was going to be here next year. If that's the case, are there certain defensive stocks you'd be buying?
Yeah, we're in that same camp. I think a recession is definitely a possibility next year and a reasonable possibility. The consumer has weakened. We have not gotten through all of this commercial real estate challenges. And we're starting to see some signs in the labor market slowing a little bit. I think, Andrew, we got to take a step back here and remember the Fed wants to slow the economy down. They're trying to get inflation back in check, and it's an uphill battle for them with all the capital that's been thrown into the system coming off of COVID. And so the Fed will get what they want. They will slow the economy down. So the idea that we're going to perfectly teeter on the edge of Goldilocks might be a little optimistic. I do think right now we've had a nice run. It's been seasonal. Traditionally, we get the Santa Claus rally at the end of the year, and the first quarter tends to tell the tale on what's really happening in the economy. So where do you go? I think you go back to the growth-oriented stocks. I think large cap value looks great. I think this spread between 7 stocks and the rest of the market starts to correct. It has this month, and I think it does next year. I think we start to see new leadership next year. We want to invest in that.
So you don't hold. So those. Here's the question, though, for everybody who's sitting out there watching this, saying, "I'm an owner of the Magnificent Seven, and most of our viewers own at least some of them." Would you continue to hold, or you're saying you want out?
Well, no, what I'm saying is that what happens in times like this, where the Magnificent Seven, or back in the 1999, early 2000s, right, the hot tech stocks, what happens is they run and they run and they run, and people hold on to these securities like they're solid gold. You have to trim, Andrew. Bring your allocations back to neutral. Take some profits. It's okay to continue to hold them. They're great companies. They're great stories. But you just can't let them run away and take on larger allocations than they should. You have to be disciplined always in portfolios.
Well, thank you for listening. I hope you had a very good 2023 in all areas of your life, both, your health, your family, your investments, and your spiritual journey, all the aspects that you pursue in your life. I hope they were positive. And as you look forward into 2024, I hope all of those areas are positive for you as well. If they were not, I hope you have a way of recovering from whatever setbacks you might have had, and that it is a positive 2024. So as I thought about looked at this cartoon, I thought this is very appropriate. The psychiatrist is saying to the S&P 500 and Janet Yellen, the Treasury Secretary, your problem is you two are codependent. I couldn't help but laugh. Thought you'd enjoy that. Have a good 2024.